In market news now, stocks fell. The dollar hit new highs as Federal Reserve Chair Jerome Powell put big rate hikes back on the table. Powell was addressing the first day of his semi-annual two-day monetary policy testimony before Congress. This morning, some of the heaviest losses were in Hong Kong, where the Hang Seng Index dropped more than 2%. Powell will appear in Congress again later in the day, signaling during the Senate testimony that officials were ready to speed up the pace of tightening and take rates to higher levels if inflation remains hot. Locally, the JSE, which is the listed company that operates the continent's largest bourse, has announced a 668 million rand distribution to shareholders as the business remained profitable and cash generative despite a number of delistings in recent years. To talk to us about the latest when it comes to the markets, we are joined by Carmen Belwana from Sanlam Investments. Carmen, thank you so much for your time. I mean, we saw the market reaction when it comes to the comments coming out of Chair Powell. What do you make of some of those comments? They were hawkish, but were they in line with what you were expecting going into this testimony?
So it's a bit of a diversified one. And I say that because had we not had the macroeconomic data that we've seen over the last few weeks out of the US, we might have had a more positive outlook. Having said that, we've seen the jobs numbers just continue to exceed forecasts. We've also seen inflation not being tempered. And because of that, I don't think that the comment should come as that much of a surprise. I think it's the extent, or at least the magnitude of what he said in terms of there will be increases for longer, which means that the expected interest rate peak that we had looked for earlier in the year is likely to be pushed out. So a lot more pain for a lot longer.
So when it comes to this idea of the Fed trying to get inflation back to 2%, does that seem a little bit, a pie in the sky at this year? Have you guys at Sanlam Investment began to have a discussion about what the Fed could be comfortable with when it comes to that inflation rate?
Yeah, so it's always a part of the discussion to determine what the different scenarios would be, what the different risk factors would be, and I guess in respect of this, what the downside risk is. So having said that, we did get an indication in the comments yesterday from Powell to say that it's unlikely they're going to move that target. If you can assimilate it to back home, and we have a range of 3 to 6, we generally try to keep it there, and that's probably more to give market a sense of comfort that the Reserve Bank is looking at sort of the risks around that, but to give you a sense of where the target would be. So it's unlikely that they would change this. I think if that was the case, it would be a very negative indicator. We have, however, seen that the increase in interest rates has not tempered the hot, should we say, US economy, and that has resulted in, but we've seen inflation continue to stay high. So unfortunately, it seems that everything that the Fed has tried to throw at the inflation rate has not yielded anything. We can have the argument that they did start increasing rates too late. But nonetheless, this is where we are now. But I don't think at this point that we'll see an increase in that target just as yet.
On that note, then, we've got the jobs report coming out this week, as well as an additional data point, and that is the CPI figure. So unfortunately, we have lost Carmen, so we'll try and get Carmen back. But she is back. So Carmen, I was saying we've got the jobs report on Friday, as well as another data print, which is the CPI figures. How important are those data points, and does it change anything at all, whether we go 25 or 50?
Yeah, so we saw in the last jobs numbers, the market was looking at the top end if you were pushing it at about 300,000 new jobs. It came in over 500,000, which was a complete overshoot. We can have an argument around why that was the case. Having said that, the consensus has gone back to looking for plus 200,000 in these next job numbers. If we do overshoot again, it's more than likely that we're going to see a higher than 25% increase going forward. And specifically, if that inflation number doesn't show any signs of either tempering or coming down any further.
We've had, we're still in results season locally. What do you make of some of the numbers that have come out from the corporates?
Yeah, a big mixed bag, depending on where you look. Having said that, I think that the key themes that we are definitely seeing is that a lot of the companies are having big supply chain issues. If you want to assimilate it to the cost of diesel and adding onto that the impact of load shedding, we've seen a lot of operating expenses being inflated because of that. And that's now become a standard in management's rhetoric around what has been impacting the companies. Then I rather look at the guidance going forward in terms of the general feel from the excos. And what we've seen is that it still remains very cautious, which we can expect under the current interest rate environment. We've seen the latest GDP numbers, and that's also going to have an impact going forward for various sectors. So, as I said, a bit of a mixed bag, unfortunately, but I think most companies have suffered because of the impact of load shedding as well.
So on the back of that, which sectors are you avoiding?
Such a difficult one to answer. The reason for that and the way that we look at investments is on a bottom-up basis, so case by case. So I don't like to say which sectors I avoid completely, more which companies. And again, it's those companies who struggle in terms of cash generation, number one, who are going to see margins that are going to be squeezed, but more importantly, where top line growth is just virtually impossible in the current environment. Adding to that, those companies that have weak balance sheets, those are the ones that I'd avoid.
All right, Carmen, thank you so much for your time. That is Carmen Belwana from Sanlam Investments, giving us her perspective when it comes to the markets. We're going to take a quick break. When we come back, we'll have the CEO of Momentum Metropolitan after this, so stay tuned.